Hello everyone. I hope you people are doing great and welcome back. We started business valuation in the last session and we will continue with business valuation and then we will solve few questions on risk management and after that I will just take all of your queries, questions, anything that you came across, any problem that you came across, your preparation for exams. So I'll be responding to that. So first of all, can you just confirm I'm audible to all of you? Okay, that's great. So let's start straight away from the question. Forbes company has in issue 9% bonds which are redeemable at their par value of $100 in 5 years time. Alternatively, each bond may be converted on that date into 20 ordinary shares of the company. The current ordinary share price of Forbes company is $4.45, and this is expected to grow at a rate of 6.5% per year for the foreseeable future. Forbes company has a cost of debt of 7% per year. Now, what we are supposed to do is we have to calculate market value of this bond, the floor value, conversion premium, and also we have to discuss about different types of stock market efficiencies. So let's start with the market value first. Market value of any bond is equal to the present value of whatever cash flows will be received. So I'm just writing a phrase that you need to remember. You will never make any mistake if you keep this in your minds. So present value, so market value will be equal to present value of all cash flows. Simple. Look at it from investors' point of view and see what cash flows the investors will be receiving and what will be the present value of those cash inflows. Now, the problem in this particular question is that we have a convertible debenture or bond, whatever it is. What does this mean? This means that after a certain time, the investor will have the option of either redeeming the bonds, that is getting their cash back, or they will have the option of converting that amount or bonds into the ordinary shares of the company, and that will be totally at the discretion of the investor. So now just understand that there are two type of cash flows that investors will be getting against these bonds. Number one, the interest payments, and number two, the amount that they will be getting on redemption. Right? These are the two cash flows that investors will be getting. But the problem is we don't know what is going to happen after 5 years in this case. Whether the investor will be redeeming and getting the cash back, or it will be converting into the shares. So In case of a convertible debenture or loan note, in this we have to go through few. We have to first find out the decision of investor, that what the decision of the investor is most likely to be, right? So what are the options available for the investor? Option one is to redeem. And if it redeems, what is going to happen? Let's read the question. Forbes company has in issue 9% bond which are redeemable at their par value of $100 in 5 years time. So it will be redeemed at par value. So against every bond, the investor will be getting $100. So this is the first option. The second option is, alternatively, each bond may be converted on that date into 20 ordinary shares of the company. And the current price of the share is 4.45, which is expected to grow at 6.5% per year. So option two is to get shares, that is conversion. And if it converts, it will get 20 shares. And what will be the price of each share at the time of conversion? That's what we need to find out. So we need to multiply 20 by the current price, 4.45. But this is the price, but this is the current market price. After 5 years, it is certainly going to be different, and it is going to grow at 6.5% rate. So let's inflate this price by 1.065 raised to the power 5. So let's inflate this price by 5 years, inflate it by 5 years, and see what will be the value of these 20 shares that the investor is going to get upon conversion. It's 121.937. So if you people are the investors, what your decision will likely be? Option two, that is conversion. So this is the first step in case of convertible bonds. Now, after 5 years, you will have a choice of either getting $100 or getting something that has a value of 121.94. So nobody will choose the lower value. So it is going to be the higher value, that is 121.94. And this has been calculated by multiplying the number of shares available upon conversion into the current market price, multiplied by the inflation rate of 6.5%. That's the rate of increase in the share price. So we have multiplied it by 1.065 raised to the power 5 to find out what the value will be in 5 years time. So it's going to be conversion, right? So now the cash flows or the benefits that this company will be receiving will be in two forms: interest, which will be 9%, and it will be multiplied by the par value 100. So that's going to be one of the benefits that the company will be receiving, and that will be received for 5 years. Remember, for 5 years it is going to receive this amount. So it is going to be an annuity. Then after 5 years, it will be getting shares value, which will have a value of 121.94. Right? So these are the two types of cash flows. So let's calculate the present value of these two. So for the present value, we need to multiply this $9 with the annuity factor, right? And the annuity factor should be taken for the cost of debt. The rate should be 7%. So it's 7%. right? So the formula for calculating annuity factor is 1 minus 1 plus 7% raised to the power minus 5 and whole divided by 7%. So it's 4.0 and let's multiply it, and it's 36.9. And in for this 121.94 we need discount factor 1.07 raised to the power minus 5. And let's add these two. That's the present value, or you can call it market value. So the value of this bond should be 123.84 today if the investors are looking for an overall return of 7%. That's what basically the concept of present value is. So if the investors are looking for 7% return, they should invest 123.84, and then they will be getting this 7% return, the overall 7% return. So this is the market value. Is this clear? So whatever type of debt is there except for the bank loan, because bank loan will never have any market value because it's not a tradable security. So the bank loans book value and market value should be the same, right? But whatever other debt instruments are, all you have to do is to calculate the present value of whatever returns or whatever benefit the company, the investor is going to get. You have to calculate the present value. A SARA tax will be ignored while calculating the market values of debts, because the tax will usually have two impacts. One will be the impact in calculating this annual interest, and the second will be the impact in the cost of debt. So if you reduce this amount by the tax and then you reduce this rate by the tax, the net impact is going to be zero. So therefore, for business valuation purpose, we do not consider tax, we simply ignore tax. So, okay, now let's talk about floor value. Now, remember one thing, the floor value is the minimum price of any security. That's called the minimum value. This value that we have calculated, it's the market value. That is, this is what uh, should be um, should be the value at the moment in a given situation, right? But What about the market value? What about the floor value, the minimum value of this investment? Uh, the problem is that here we expect that the share price will grow, and it will grow to 121.94, and that's why we have assumed that the investor will not redeem it, rather the investor will be converting it, right? So on the basis of this assumption, we have calculated this market value. But my question to all of you is, what will be the worst situation after 5 years? What will be the worst situation? That's the best situation, right? That the share price will be growing and the investor will be getting $121.94. But what will be the minimum that this investor will be getting after 5 years? 100, right? 100 will be the minimum that this investor is going to get. That's the minimum value that the investor is going to get. So even if the share price does not grow in the future, and even if stays at the same level, the minimum that this investor is going to get after 5 years will be $100. That's the minimum it will be getting. So instead of putting this most likely value that the investor will be getting, if we put the minimum that he will be getting, the final answer that we will be getting will be the floor value, or we can call it the minimum value of this investment. So let's let me copy this. The interest will still be received, right? And this will have the same value. But let me assume that the worst situation will be that the company will be redeeming the shares. Sorry, redeeming the bonds. Right? And if it redeems, it won't get 121.94. It will get rather, it will get $100. It will get $100. And if we take the present value of these $100, it will be 71.3, and the value will be 108, and we should not call it value, we should call it floor value, the minimum. This is the worst case, and in the worst case, even then it will be getting $100. So that's the minimum value, which we call floor value. So the floor value or the minimum value of the company will either be calculated with the help of these figures, or there is another way of finding out the minimum value, or floor value will be the market value of a straight debt of similar type, similar term, similar debt. Better to use the word. So what does that mean? If there is another debt instrument, let's say another bond, which has the same term to maturity, that is 5 years, which has the same coupon rate or interest rate, that is 9%, and has the same risk level, but the only difference is there is no conversion option. Let's say there's no conversion option, and the company is redeeming the bond at par after 5 years. At whatever price this particular bond will be traded currently in the market, that price will be considered as the minimum value of this convertible debt. And the reason is very simple. If you have two similar type of bonds with the same coupon rate, same term to maturity, same risk level, and one bond is giving you the option of conversion, whereas the other is not giving you the option of the conversion, do you people think that the convertible one will be traded at a lower price than the one that does not have the conversion option. Do you people think? So we can simply say that the minimum value of that convertible debt will be equal to the market value of a similar type of debt that does not have any conversion option. So is that clear? And let me explain it with another example. Another example, Asher, especially for you. There are two cell phones that one of you want to buy one of them, right? One cell phone has the option of Wi-Fi, the other does not have the option of Wi-Fi, and the rest of the features are all the same. The only difference is one has Wi-Fi and the other does not have the Wi-Fi option, right? Will you buy, will you buy, or will that shopkeeper, will he sell that Wi-Fi cell phone at a lower price than the price of the cell that does not have Wi-Fi? Asher, right? So the cell phone with Wi-Fi option, the cell phone with Wi-Fi option will be sold at a higher price, but the minimum price of that Wi-Fi cell phone will be equal to the price of that non-Wi-Fi cell phone. It won't be sold for a lower price than that non-Wi-Fi cell phone. Is that clear? Similarly, a convertible debentures minimum value will be equal to the market value of a debenture that does not have the conversion option. But in case we do not have a similar type of debt, in case we don't have a similar type of debt, then this is how we calculate the floor value of a convertible debenture. That's how we calculate it. This is a theoretical model. That's the theoretical model of calculating floor value of a convertible debenture. The practical method is the actual market price of a straight debt. I hope it's clear for everyone. Hamza, if the conversion option is lower than the redemption option, the company will go for redemption option. And in that case, both market values and floor values will be same. Okay, from 1 to 5. I'm happy that colleague gave me 5. Thank you so much. Okay, last one, the conversion premium. Conversion premium is equal to market value minus current conversion value. Yes, you can, but I hope it's not out of 10. It's 8 out of 8. So what's the conversion premium? The conversion premium is the difference between the market value and the current conversion value. So let me calculate first and then I'll explain what does this actually mean. So the market value that we have calculated is 123.84, whereas the current conversion value is the value of the shares if these shares are converted now. If we convert the shares now, the value that we'll be getting upon conversion will be called current conversion value of the bonds. So 20 shares are available and current market price is 4.45. So we just need to exclude the growth. That's it. Okay, did I do any mistake? No, it's 34.884 conversion premium. Now, what does this mean? If this investor has to invest in these bonds, how much the investor will be investing today? How much the investor will be investing today? How much is the investor expected to invest today to buy these bonds? Everyone, I need answer from everyone. If the bond is to be sold today, how much the investor needs to pay to get each bond? Well, obviously it should be the market value, 123.84. The investor will be paying $123.84 to buy this bond, right? Okay. How many shares the investor may get after 5 years if he decides to convert? How many shares? 20 shares, right? And what is the value of each share at the moment? 4.45. Very right. And what will be the total value if he convert it convert the bond into shares now? $89, right? So look at from the investor's perspective and think like this investor. The investor will be thinking that I'm going to get 20 shares in return of this bond. These shares will be available after 5 years, but these shares have a value of $89 today. So it means what I'm going to get after 5 years has a value of $89 today. And against this, I am going to invest $123.84, right? Just for the time being, just forget about the shares. Suppose that the investor, the company is guaranteeing you that they will be giving a piece of land against the bond. And that piece of land has a current value of $89. So the company is committing that they will be giving you a piece of land which has a value of $89, but that land will be given to you after 5 years. But today you have to invest $123.84, right? So just think from the investor point of view, how much should the value of land grow so that it equals the amount that you are investing today? How much should the value of this land grow in the future so that it equates or it equals the amount that you're going to invest? So this 89 has to grow by 34.84 so that it equals the amount that you're investing today. And that is basically called the conversion premium. Is that clear? So if you want to describe this, you should describe it in this way. It's the value by which the current conversion value has to increase so that it equals the market value of bond. So that's current conversion. So that's conversion premium. The last part of the question is briefly discuss weak form, semi-strong, and strong form market efficiency. So, do you people have any idea about market efficiency? What is market efficiency? I'm not talking about the form of efficiencies. Just tell me what is meant by market efficiency. Okay, let me explain in very simple words, right? Very simple words. Let's say you saw an advertisement of somebody selling his car, and on the advertisement it said the condition is excellent, right? And by just looking and looking at the description of the car, you made your mind that you are going to buy this car for say $20,000, right? You made your mind that you are going to buy this car for $20,000, right? And you just you just came out of your office or home so that you can go to that person and buy the car. And on your way to that person, you got a message that that car has got some minor accident, right? Now, will you still have the same value for that car, or now you will value that car at a lower price than you previously thought it should be valued at? And by you, I mean the market, because you are the market. You are the one who's buying the car. And by you, I mean the seller. By you, I mean the buyer. So the market responded to a new piece of information. The market responded to a new piece of information, and the response of the market is always in the form of a price. So the price of a share may go up or may go down. That price movement is basically the response of the market, and the price that goes up or comes down depends on the information that the investors have, or the people in the market, the people trading in the market have. Due to that information, the price changes, and that's called the response of the market. Now, at what speed, at what speed this market responds to a piece of information is called the efficiency of the market. The car got the minor accident, and then you came to know about this accident, and immediately the price went down. So what type of information changed your mind? The future information or the past information? What was that information related to? What was that related to future, or was that related to past? That was related to past. When you were leaving home, the car was going to have this minor accident, but you did not know, or you did not predict this information. The moment this accident happened, and the moment you got the message, the price changed. So you responded to a historic information, to the past information. But if you came to know about this information before the accident, the price would have reflected, or the price would have changed in your mind immediately, if you had the ability to predict what is going to happen, right? So that's the efficiency you have. You only responded when something happened and was publicly known. Similarly, a stock market responds to a change, responds to a new piece of information coming into the market. Now, if a stock market only responds to a past information, it is said to have weak form of efficiency. So what does this mean? Theoretically, no stock market in the world has this level of efficiency, and it will be um, understood in a while that why is that so. You know, it is an era of information. I'm sitting here in Pakistan. Is there anyone attending this session from Africa? Anyone who's from Africa? Okay, Coley, James, they're from Africa. Anyone from UK? Anyone from UK? Yep. Anyone from India? See, So we have people from different geographical locations. So you're listening to someone from Pakistan with the help of this technology. So can you imagine the stock market and the people in the stock market not knowing any information that is publicly available? Can you expect? You know what does this mean? This form of efficiency, what does this form of efficiency mean? This assumes, this assumes that the stock market is only aware, the people in the stock market, the ones who are trading in the stock market, they are only aware of the information or aware of any incident that has happened in the past. And they don't know anything about the future for which the decision has already been taken and made public. For example, company A has decided to acquire company B, right? But they haven't acquired it yet, but they have made this decision publicly available. Everybody, they have just given it in the newspaper. They have just put it on their website. They have just put it on the internet that they are going to acquire company B. Do you really think that the stock market will be so inefficient that something that is publicly available, but the stock market investors, they won't have this information? Do you really think this is possible? No. A hasn't acquired B, so it's not a past information. A hasn't acquired B, it is still to acquire B. But since it has made this thing publicly available, people in the stock market will be aware of it. And they will have this information and they will immediately respond to this information. And this will affect the share price of the company A or company B. So my question to all of you is, if I assume that B company's acquisition is good for company A, I'm just assuming it's good for company A, what do you think the share price of the company will change to? Will it increase or will it decrease? The share price will increase, right? But you know what? This form of efficiency, the weak form of efficiency, assumes that even if A has made this information publicly available, nobody in the stock market will know this impact and no one will respond. No one will respond to this change. No one will respond to this change. And nobody will have any idea in the market at large that this is happening. And the share price will stay the same until the merger actually happens. Do you really think that's possible in today's world? The stock market will respond because of this publicly available information, even if this event hasn't happened yet. And the share price will go up before the actual merger takes place, because everybody will start buying the share of company A because they will be expecting that the share price is going to go up after the merger. So everybody will respond and the share price will go up before the merger takes place. So the share price will respond even if the merger won't hasn't taken place yet. So in theory, in practice, a stock market will will respond, or the stock market price will always reflect the past and publicly available information. A stock market will not only reflect past information. It will also reflect any future information that is publicly available. And this is called semi-strong efficiency of a stock market. And that's the practical one. Most stock markets, in fact, all stock markets show this form of efficiency. And there is another one, which is an illegal form where a strong form efficiency is a form in which even insider information is reflected in the share price. You know what? What does this mean? A strong form market will be such that investors in that market at large will even come to know about a merger decision, even if the companies involved have not made this information publicly available. It has just been decided between few directors and they haven't made it available publicly. They haven't made this information publicly available, but still the whole market will know this information and the stock market will respond to this. That's not possible. That's called insider dealing, which is illegal. You cannot, you are not allowed as a director to buy a share of a company in such a situation where such a big change is coming up to the company. That's not allowed. So there are corporate governance laws or rules where the directors having such information, such big information, they are restricted to get into buying or selling the shares with such type of information in hand, because that will jeopardize the value of investments of the general public. So it's not allowed. So most of the stock markets, they have this semi-strong efficiency. Is that clear? Yes, the car example was somewhat a weak form of efficiency because you only came to know um, once that thing happened, because nobody's gonna have an accident and in the future and they will be telling you beforehand that they are going to have an accident and they will make it public. So that was a very limited example just to explain um, how information availability changes the value of something. So that was just an example of a relationship between information and value of something. Right? So I hope I have explained um, the three forms of efficiency. So let's move forward then, and should we have a a break of 10 minutes before I move towards risk management, because I don't want to continue risk management without a break. Should we have a 10 minutes break? Okay. So we will be back after 10 minutes. So back guys, let's now start our risk management part. And we have a question straight away. Discuss differences between transaction risk, translation risk, and economic risk. Well, first of all, let's discuss exchange rate risk. What is exchange rate risk? Exchange rate risk is, let me explain with the help of an example. Let's say uh, you are you have a company outside US, right? And you have to pay a US supplier $1,000 because you have bought something today for which you have to pay $1,000. You have to pay $1,000 in, let's say, 1 month's time, right? And let's say uh, $1 is equal to £1 today, right? $1 is equal to £1 today. It's and if £1 is equal to $1 today, it means you will need 1,000 pounds if you make this payment today. But the risk may be that this dollar appreciates in value and becomes more expensive. And maybe we need two currency units, two local currency units, that is £2 sterlings, two sterlings to buy $1 after 1 month time, right? Then how many pounds sterling we would be needing in 1 month's time to buy $1,000? How many sterlings we will be needing to buy $1,000 in 1 month's time? Yeah, I just searched for the sign, but I could not get it. No, it wasn't there. No, it's not working. No, it's okay. It's okay. Just tell me the answer. How many pounds sterling we would be needing in 1 month's time if we need two sterlings to buy $1 in 1 month's time? 2,000. It will be 2,000. We will be needing 2,000 pounds sterling. And today we need 1,000. So it is increasing. It is increasing our cost by 1,000 pounds sterlings. So if the exchange rate goes up to 2 sterlings, we will be at loss, and this risk is because of the exchange rate moving upwards, and that is called exchange rate risk, where exchange rate changes in such a way that it puts us at loss. That's called interest exchange rate risk, right? Now there are three types of exchange rate risk: transaction risk, translation risk, and economic risk. So quickly, if somebody can tell me what is transaction risk? What is transaction risk? What is transaction risk? Transaction risk is the one that we just discussed a while ago. When you have entered into any foreign currency transaction, either you bought something from an international supplier or you have sold something to an international customer, and then you have to pay or receive the foreign currency in the future, and the exchange rate movement may increase your cost or reduce your income because of exchange rate movement. That is called transaction risk. It's a short-term risk. And what is translation risk? You know that a parent company is required to prepare consolidated financial statements. If it has a foreign subsidiary, you know that that foreign subsidiary's financial statement will be in the local currency of that country, whereas the parent company may be in some other country, and its financial statements and its grouped financial statements will be in the currency of the country in which is operating. So it can't just simply pick the figures from the financial statements of the foreign subsidiary and just add it. You can't add $1 into £1 sterling. So the parent company is required to translate all the assets, liabilities, and capital and income statement items of the foreign subsidiary into the local currency of the parent company, and then consolidate the financial statements. Now, if after translating the foreign subsidiary assets into the local currency of the parent company, and it results in a loss in the value of the asset, that is, the value goes down of any asset because of the translation, that is called translation risk. That's called translation risk. And what is economic risk? Anyone? Economic risk is a long-term risk, and it arises because of a different economic performance of two countries. If their economies perform in a different way, one is performing better, the other isn't performing that better. The relative performance of the two economies is different, then it results in exchange rate risk. So it is called economic risk. Now, explain how inflation rates can be used to forecast exchange rates. Now, it is asking for a theory, that is purchasing power parity theory. So that's just an explanation. I will upload. I have uploaded risk management handouts in which uh, the exchange rate movements due to inflation, the topic has been explained there. So I'll just skip this for a while, and I'll just jump to the C part. Calculate the expected sterling receipts in 1 month and in 3 months using the forward market. So I'm just going to do that working for you. So it says that calculate the expected sterling receipts in 1 month. Rida, in part B, it's just a straightforward theory question. My handouts does have the explanation of purchasing power parity theory, and it is just asking about that theory. That's it. Okay, Asher is asking that, sir, what is meant by direct quote and indirect quote? Direct quote and indirect quote, right? So let me explain it. Like in Pakistan, our currency is rupees, right? And if exchange rate here in Pakistan is quoted in rupees, that is called direct quote for us. For example, if they tell us that $1 is equal to 150 rupees, if you want to buy a dollar, it is equal to 150 rupees. 150 rupees per dollar. This quote is a direct quote for us. But the same quote is indirect for a US company. If they are told that against $1 they will get 150 rupees, for them it will be an indirect quote. So if exchange rate is quoted in local currency, exchange rate is quoted in local currency, it is called direct quote. And if it is quoted in foreign currency, then it is called indirect quote. Okay, let's move forward. Calculate the expected sterling receipts in 1 month and in 3 months time. So I'll just do the calculation for 1 month, and you have to repeat the same calculation for 3 months. I'll give you time, but first let me calculate it for you. What are we going to receive in 1 month's time? We are going to receive $240,000. It's a UK company that is expected to receive 240,000 US dollars in 1 month's time, but at the same time it is going to pay 140,000 US dollars. So remember, if a payment is to be received or a payment is to be made at the same time period, in the same time period, they first need to be netted. We have to net off this figure first and then go for any hedging method. So net receipts should be calculated because receipts are more. That's why there are net receipts. 240,000 minus 140,000. So this is the amount that we need to hedge. That's the amount we need to hedge. Okay, because this company is going to receive $240,000, in 1 month's time, and it is also going to make a payment of the same currency after 1 month time. So the timings are the same, and the currency unit, they both are same. In that case, we first need to net off the figure. There is no point of hedging the receipt first and then hedging the payment first, payment then. So it's better to hedge the difference, because the time when we will be receiving 240,000, we can pay 140,000 out of this receipt. So we will be only left with $100,000 after 1 month's time. So better to hedge this $100,000 only. And in case the payments were higher, we would have written net payments. So it depends on whether receipts are higher or payments are higher. So let's now look at how many pound sterlings we will be getting against these $100,000 in 1 month's time if we go for a forward market hedge. So what's the 1 month forward rate? That's the 1 month forward rate. That's the 1 month forward rate. But it has been quoted in a strange way, plus minus 0.0003. What does this mean? This means that we have to add 1.7829. We have to add 0.0003 into this figure once. We have to add once, right? And we have to subtract the same figure once. So we have added, and now we are subtracting 0.0003 from the same figure, 77829 minus 0.0003. The two rates are basically the buying and selling rates of a bank. Sometimes a question may make things easier, and they may quote these prices as it is, and sometimes they may be giving us in this format. So for this, in this format case, we should add this 0.0003 first into this amount, and then we should subtract to get the buying and selling rate of the bank. So one is the buying rate of the bank and the other is the selling rate of the bank. Okay, now just a quick question. This company, is this company going to receive $100,000 or is it going to pay $100,000? Because the question is asking us to calculate the pound sterling using the forward market. That's why we have used the forward rate. Okay, so we will be having $100,000 in 1 month's time, and these will have to be converted into pound sterling. Right? So these have to be converted into pound sterling in 1 month's time. Now, when we will be converting it into pound sterling, basically what we will be doing, we will be giving these $100,000 to the bank, and against these $100,000 we will be getting the local currency, that is pound sterling, right? But we have got two rates, this one and this one. Which one are we going to use? The question, the first question is, which of the two should we use? So I just want you people to concentrate, because this is something that puts most of the students into problem. Which of the two should we use? The first question. And the second question should be whether we are multiplying with the rate for conversion sake or dividing by the rate So these are the two questions that we need to answer first, and I'll give you the rule. Just hold on your horses. I will just give you the rule of whether, how should we be deciding whether we should be multiplying or dividing with the rate. This is the first thing that we need to do. My question to all of you is, in which currency has these rates been quoted? In which currency have these rates been quoted? These rates have been quoted in dollars, right? And in which currency are we converting? Pound sterling. Now the rule will be multiply by the rate if the amount will be converted in the same currency as the currency in which rate is quoted. Otherwise, divide. The rate given is in US dollars, whereas we are converting into sterlings. So what should we be doing? Dividing. Yes. Now it's very much clear now. We must be dividing $100,000 by 1.7832 if we need to convert it into pound sterlings. Okay. So we will be dividing, right? So let me make some space and cut it. Okay, let me divide it by both these figures to see what amount of pound sterling are we going to get. And let me divide 100,000 by the second rate as well, though we don't have to do it twice. I'm just doing it for sake of explanation. So I've divided them by both, I've divided the currency by both the rates, right? So I've done it by both. Okay, if I divide it by this, the amount will be 56078. And if I divide it by 1.7826, the amount is going to be 56097. So the bank is either going to give this amount or this amount. What do you think? What is good for the bank? Paying us higher or paying us lower value? Look at it from a bank's perspective. The bank's benefit will be to pay us a lower amount, and that is 56078, because this is slightly higher. So this is the rate that we should be using in this case. You should always look at it from a bank's perspective. Yes, so that they can make the profit. When they will be selling the same $100,000 to you, they will charge you 56097, which is higher. But by buying the same amount of currency, they will be just paying you 560,786, and the difference is their profit. If they are buying $100,000, they will just pay you lower value. And if they are selling this to you, they will be asking for a higher amount from you. In this case, we are going to sell $100,000 to the bank, and the bank will pay us in pound sterling, and definitely they will pay us the lower value. The bank will never pay us the higher value. So this is the amount that we should be taking, and I'll just simply ignore this. Just ignore this. I've just highlighted this. We don't need this. So the pound sterling that the company will be getting in 1 month's time will be equal to this amount, and it should not be dollars, it should be pound sterling. So it's pound sterling. So this is the amount that the company will be getting after 1 month's time, if it goes for forward rate contract. That is, it fixes the exchange rate with the bank. So I'll just give you 5 minutes to solve the same part for a 3 months forward contract. The question says, calculate the expected sterlings in 3 months using the same forward market. So go ahead and solve it for 3 months. What will be the amount in pound sterling that the company is going to get after 3 months? So I hope you people have done it. So let's quickly do it. The only change is that we need to pick 3 months forward rate instead of the 1 month. So the 3-month forward rates are 1.7829 plus, sorry, 1.7846 plus 90004. That's the rate we should be using. And after 3 months, what is the amount that we will be getting? Okay, we have receipts or we have payments. After 3 months, we again have receipts. So we had receipts and we still have receipts. So the rate should be the same. It's only the amount that has to change. The amount will be $300,000. And if we convert it into pound sterling, this is the amount that we'll be getting after 3 months. That's it. Right? Let's move towards the more interesting part. That is calculate the expected sterling receipts in 3 months using a money market hedge and recommend whether a forward market hedge or a money market hedge should be used. So we have already calculated the amount of sterling that the company is going to get using the forward market. Right? Now we have to calculate the same sterlings, assuming that the company is going to use money market hedge. So, and we'll compare the two, and definitely we will choose the one in which the company receives more pound sterlings. So money market hedge. So definitely I'm going to explain money market hedge. So I want you people to listen carefully, and I have a request from all of you. Do not ask any question unless I ask you to, right? I will definitely allow you to ask me questions. First, just listen carefully. Even if you miss anything, don't worry, I'm going to repeat. A money market hedge is when a company uses short-term borrowing and short-term lending, short-term borrowing and short-term investment to hedge its exchange rate risk. Now, first try to understand what is risk. Risk comes with variations. When you are not sure of what actually is going to happen in the future, then you are in a situation where there will be a risk. Like we are not sure whether we will be receiving $5,000 or we will be receiving $5,000. We expect either we will be receiving $1,000 or we expect that we'll be receiving $5,000. Definitely we will always want to receive $5,000 if we have these two possibilities, but there is a chance that we may receive $1,000. That's the risk. So it always comes with variations. When there are no variations, there is no uncertainty, there will be no risk. So we can use money market to create a certainty related to what exactly we will be receiving in 3 months time or 2 months time or 1 month's time. Like in case of forward contract, we have calculated exactly what we will be receiving in 3 months time. We know today what are we going to receive in 3 months time because we entered into a forward contract with the bank and we are sure of what we are going to receive in 3 months time. Irrespective of what the exchange rate will be in 3 months time, we don't care now because we have fixed a rate with the bank and that is 1.785. When we fix a rate with the bank, the uncertainty is gone and there is no more risk. Similarly, if we find out through a money market hedge that what exactly are we going to receive in 3 months time, that means we have hedged our risk. The risk is gone because there are no variations expected. And let's now see how we can find out today exactly what we will be having in 3 months time. So first, my question to all of you is, it says calculate the expected sterling in 3 months time, right? So we should look at the payment that we are going to receive after 3 months time. So after 3 months time, are we going to receive something or are we going to pay something in foreign currency? Receive, right? So it's a case of receipt, and that's 300,000. Very good. So it's a receipt case. Okay. If we don't hedge this risk and we don't do anything, in 3 months time we will receive $300,000, but that we know that it will be 300,000. So we are very much sure about 300,000. But what we are not sure is how much in local currency we will be getting after converting these $300,000 in 3 months time. That's what the uncertainty is. That's where the risk is. We may receive more, we may receive less, but we're not sure what is going to happen once we convert it into our local currency. That's what the dilemma, that's what the problem is. And we want to use money market to be sure today what we are going to get in 3 months time. Okay, what should we do? Since we know that we are going to receive $300,000 after 3 months, right? If we need this amount today, but we know we are going to receive this after 3 months, what do we have to do if we need this amount today? Do we have to invest $300,000 today, or do we have to borrow 300,000 today? Yep. We have to borrow, right? We have to borrow. So whenever we are expecting a receipt, we have to borrow. Remember this combination. With receipt, we have to borrow. What should we borrow? If we borrow $300,000 today and we use it for 3 months, will we be paying more than $300,000 to the bank or less? We will be paying more because of interest. And we cannot afford this because we are going to receive $300,000. So we have to borrow an amount which after 3 months will grow up to $300,000. So we have to basically borrow present value of $300,000. So borrow present value of $300,000. So that after 3 months, this amount grows up to $300,000. And upon the receipt of this amount, we should pay this to the bank from whom we have borrowed. So what should that be? Let's calculate present value. Present value will be calculated as S into 1 plus the rate. So what are we borrowing? Dollars or pound sterlings? Dollars. We are borrowing dollars. So we should go to the question and see what's the borrowing rate of the dollars. What is the borrowing rate of the dollar? Borrowing rate of dollar, it's 5.4%. 5.4%. And it is for 1 year, right? It's for 1 year, and we are borrowing for Rida. Since we are borrowing dollars, therefore we should use the borrowing rate of dollars. Simple. So 5.4% is the annual rate, right? And we are borrowing for 3 months. So we should have a 3 months borrowing rate. So we should divide this rate by the quarter, by number of quarters. So 5.4 should be divided by 4 to find out a 3 months rate. So we must divide this annual rate by the quarter to get a quarter rate, a per quarter rate, because 3 months mean 1 quarter. Okay. And the power should always -1. It should always be -1, remember, because we have taken a 3 month rate and we are calculating for this 3 month period, which is considered to be 1 quarter. So we have put a quarterly rate and we need to find out the value based on 1 quarter. So it's always going to be 1. That's the present. No. Again, mistake that I made. I need to put bracket around this. So it's 269,004. That's what we are going to borrow today. After 3 months, this amount will be increased to 300,000. And by that time, we will have to pay the bank $300,000, and we won't be worrying about it because we will be receiving the same amount from our customer. So we will straight away receive this amount and pay to the bank, and the liability will be settled. So this liability will be settled through the foreign currency receipts. So we don't have to worry about this payment anymore. So by the time we will receive this amount, we will not have to convert it into pound sterling. We will straight away pay this to the bank from whom we have borrowed this amount, right? But we can't keep this amount idle. Now we have these dollars in our hand today, and we cannot keep this amount as idle. So we have to invest it in another investment. So we have to invest this amount. So invest 296,004 dollars. But the problem is we cannot invest in dollars because we are going to have pound sterling at the end of the day. We don't want to have dollars after 3 months time. Again, we will be in problem of conversion, right? So we cannot straight away pick these dollars and invest. So first we need to convert this 269,004 into pound sterlings. So that's why I have left this space, so that you should know that these dollars should not be straight away invested. They should be converted first into sterlings today. Again, for converting, we need a rate, but this time we need a spot rate. We don't need forward rate because we are not entering into any agreement with the bank. So we should be using the spot rate. Remember, most of the students, they may make a mistake here. Don't use forward rate. Forward rate agreement is a separate hedging arrangement. We should use spot rate, and the spot rate will be either it should be the +1 or it should be the -1. So we have dollars and we need to convert these dollars today into pound sterling. So we have to divide it by the higher rate because the bank is going to pay us less number of pound sterlings. So first let's calculate the rate. What the rate is going to be? It is going to be 1.7820 plus 0.0002, and it will be 1.7822. 1.7822. This amount should be divided by 1.7820 plus 0.0002. So, and let's divide. So if we convert these dollars into pound sterlings today, we will have 160,660,89, and now we don't have these dollars. Instead of this amount, we have our local currency in hand. This should be invested. Invested for how many months? For 3 months. So after 3 months, are we going to get the same amount, or we are going to get a cumulative amount, that is the principal plus interest? So we will get interest as well. So it means that we need to find out the future value now. So yes. I thought you people will accept this. I didn't know you people will be. Okay. So let's calculate the future value. Now we are investing the sterlings, so we should pick the investment rate of pound sterlings. What is the investment rate of pound sterling? The deposit rate of sterling is 4.6% annually, and we need to convert it into quarter. Okay, the amount is 166,089 into 1 plus 4.6% divided by 4 to get it per quarter rate, raised to the power 1. It should always be 1. That's it. And that's sterlings in 3 months time. So what are we going to have after 3 months in pound sterling? This is the amount that we are going to have in pound sterlings. So right now we know that what we will be having after 3 months in pound sterlings. So we don't have any doubt anymore that what local currency units we will be having in 3 months time. We have used banks, we have used short-term borrowing and lending to find out exactly what we will be having in 3 months time, and that is called money market hedging. Now we have two options. either to have 167,999 if we enter into money market hedging, or we can have a forward rate contract. In that case, we were having 168,067 sterlings. So which option should we choose? 167,999 or 168,067? Though the difference isn't that big, but still the bigger answer will be chosen. Shumaila, we will be having more pound sterling in case of forward contract than in case of money market hedge. So therefore, it's better that the company choose forward contract. Now, I'm just displaying a question for all of you, and I want you people to solve this question. I'm giving you 10 minutes to solve this question. And at the end, I will also show you a shortcut of money market hedge, which you can use in your exams as well. But first, solve it. And I'll solve the same using the shortcut. Hope you people are done with this. Okay, now how to calculate a forward rate? Remember, a forward rate is always calculated using interest rates, interest rate parity theory. So the formula is spot rate. Spot rate is 20, okay, into 1 plus the interest rate. Now, the interest rate should be, when you are calculating the forward rate, the interest rate in the numerator should be of the country in which the exchange rate is quoted, is being quoted. The exchange rate is quoted in dinar. It is quoted in dinar. So in the numerator, we should have the interest rate. We should have the interest rate of the company that's currency is dinar. Now, the home currency is dollar. We don't need this one. We need the foreign currency rate, and that's 7%. So in the numerator, 7%, and that is because the rate is quoted in dinar. Right? And then we should divide it by the interest rate of the other country. Simple. So we have already picked 7%. We need interest rate that is 3%. Oh, no. So not changing. Is it per year? And okay. I'm sorry. I thought we are to calculate after 1 year. It's a 6 months. It's a 6 months forward rate, so it should be 3.5% then, and it should be 1.5%. My bad. I thought we are going to calculate after 1 year. So 20.39. Thank you so much. So the key point is that the rate in the numerator should be of the same country in which the exchange rate has been quoted. That's the key point. So we have got the forward rate. Okay, let's solve another question. Solve this one as well. The date is 31st January 2014, and entered into a contract. They will receive 300,000 US dollar from a US customer on 1st April 2014. So it's February, March, March, 2 months, right? It's 31st January and they're going to receive on 1st April. So it's February and March, 2 months. And ACCA's company is a UK company. So the local currency is pound sterlings. And there is a forward, there are 3 different forward rates agreement available. Which one is relevant for us? 2, 3, or 6 months? 2 months, right? Yep. Okay. Let's first convert the rates into buying and selling rates. 1.6, 1.6 plus 0.05, 1.65, and 1.6 minus 0.05. So these are the 2 rates. And we have US dollars. The rate is in US dollars, but we want to convert it into pound sterling. So what should we be doing? Dividing or multiplying? The rate is in pounds, the rate is in dollars, and we are converting it into pound sterlings. So we must divide. Okay, after dividing, we will get the sterling amount, which should be less because the bank is going to pay us less. So we should divide it by the higher value. So we should not use this one. So the amount is $300,000, and we should divide it by 1.65. Okay, when the rate is quoted in one currency and we are converting it into another currency, we must divide it by the rate. And if the rate is quoted in the same currencies in which we are converting, then we should multiply. That's a simple rule you should remember. Right? In this case, we have dollars and we need to convert into sterlings. And the rate is in dollars. So rate is in dollars and conversion is in sterlings. So these are 2 different things. So we must divide. Now, when we will be dividing, there will be 2 options of dividing. Either we should divide it by 1.65 or we should divide it by 1.6 minus 0.05. That is 1.55. So if we divide 300,000 by 1.65, we will get 181818. And if we divide the 300,000 by 1.55, we will get 193548. So the bank is either going to pay us 181818 or it is going to pay us 193548. So which amount the bank is going to pay us, the higher or the lower one? The lower one. Obviously this 18181881. So we should not use this rate. Why should we be using this rate? The bank is not going to pay us this amount. So it should be 1.65, and that's what we are going to receive. So that's it. The risk management part is also over as per plan, and I am done with the syllabus. And as I told you that I will open the session for question and answers. If you people have any queries, anything that you want to ask, anything that you have come across while you were studying, you can ask me now, as all of the questions that I planned to solve, we are done with this. Okay, so it will be great if you ask questions one by one and let me answer one question and then you should ask the other one. Otherwise, I will be missing your questions. So I'm coming up with the first question asked by Asad, and he says that, sir, can you give me a quick recap of forward rate agreements? Yes. So I'm just explaining the forward rate agreement first. For FRA, forward rate agreements, Asad, are you talking about the exchange rate or you're talking about the interest rate? Interest rate, right? So it's a simple thing. If I need a loan, a bank loan after 3 months time, right? I need a bank loan after 3 months time. The current interest rate is 6% in the market, and I fear that this rate may go up. Say it may go up to 10%. Let's say that's what my fear is. So what I can do is I can go to the bank today and ask the bank to fix a rate for this 3 months. So for this loan that I'm going to take after 3 months. So I may ask the bank to fix this rate today, and the bank may say, okay, fine, let me fix the rate at 8%. I'm just randomly picking up the numbers. Let us fix the rate as 8%. So whenever, this is what the bank is saying, that whenever I will go to the bank, now the bank is going to charge me 8% interest for the loan that I'm going to take after 3 months. So this is called a forward rate agreement, in which the bank will fix the interest rate for any loan that I'm going to have after some time in the future. Asad, is that okay? Okay, let me go for another question. Just hold your horses. Let me give answers one by one. Otherwise, I will miss your questions. Okay, AXA says that, sir, what should we have the plan to revise? Uh, a best way of revising a syllabus will be to pick one question from every topic randomly, especially if a question that you have never solved before. Just pick questions randomly and solve without looking at the solution. If the question is solved without any problem, get to the next topic question. And if you get a problem in any question, just revise that topic only. It will save your time, and you will be able to revise the most important topics for you, especially the ones you are having problems in. Okay, there are so many other questions. So Ifra is saying, sir, why do we not include preference share capital in denominator in ROE? ROE. Okay, Ifra, can you just tell me when we are calculating return on equity, what profit do we use in the numerator? profit after tax, or is it profit after tax after preference dividend? Yes, it's profit after tax after preference dividend. So if we have subtracted the return of the preference shareholders from the profit, then what's the point of keeping the investment of preference shareholders in the denominator? Next question. Fareen says F9 paper consists of more theory in proportion. Well, I can't say this. You can say it's 60-40 either ways. Sometimes you may get 40% paper based on theory and 60% based on calculation. At the other time, you may get it the reverse. Emily says, what is equivalent annual cost? It's a lengthy concept. Um, it needs a very detailed explanation. Just come up with small queries. Kohli says, what's your advice to approaching the exam question? That's an interesting question, and majority of you will be interested in knowing the answer to this question. Approach. Uh, any question when you are trying to solve, always start with the requirement. Do not ever start reading the data or the information in the question. Always start the question with the requirement. This is the first step. Once you have read the requirement, you should be sure that you have completely understood the requirement and you know what exactly the examiner has asked. Once you are sure of what you have to calculate, then plan the answer. Do not jump into solving the question. First, plan the answer. What should be your first step till your last step? Plan it. After planning, look for the information that you will be needing in solving the question and only use that information and ignore everything else, because sometimes there will be irrelevant information and that is just for the sake of trapping you. That should be the approach. When cost of debt is given for a bank loan, do we need to deduct tax from it? Well, Wasim, what are you going to use that cost of debt for? If you are going to use it for calculating weighted average cost of capital, then yes, you should deduct the tax from it. Asad says that, sir, which section should we start first, A or C? My suggestion is never ever start section C. Always go through section A first and pick up the low hanging low hanging fruits. Solve the very easy MCQs first. They will be confidence booster. Sir, can you explain interest rate futures? Sanket, it's a detailed concept. It is a detailed concept. Just ask me this question again on the group. I have a solution for this, and I will just discuss this in detail on the WhatsApp group. Yes, the CB format. You haven't given any computer-based exam before. Emmeline, if you have gone through the syllabus, then definitely it's the past papers that you should be doing in the last 10 or 15 days. Kali, you are talking about Islamic finance, right? Hmm. Well, I think I have shared Islamic finance course notes in the exam in the Google Classroom. In case they are missing, just drop me a message. I will upload my own handouts, course notes on Islamic finance. They are very comprehensive. Yes, they can be examined. Sanket, most probably the section C will consist of net present value calculations. It may have a question from sources of finance. It may have a question from working capital, and probably apart from cost of capital. But I never look at financial management paper from this perspective. It does not make any difference whether you get a question um, in the CRQ or in the MCQ. The concept remains the same. It's only the execution on the exam day that will be different. That will be different. Well, inventory management, I don't think it will be a favorite area of the examiner. That's my assessment. Receivable management is something that will be favorite for the examiner because I feel that that's the area very poorly attempted by the students. Most of the students, they are good with the inventory management part, but they feel it difficult in the receivable management. So if I'll be the examiner, I will be more interested in giving receivable management. Aksa, the most important area is the most weak area of you. That's the most important area. That's not a diplomatic answer. If you just look at it in detail, for you, the most important area is the one that is in which you are very weak. That's the most important area for you. Wow, Aksa, best of luck for your CA as well as ACCA. So, San, that's the most important area for you. Just work on it. Emmeline, it's you have asked a question, or you have simply asked me to write an essay on psychology in just one sentence. It will be difficult. Collie says, sir, when do we use Gordon growth model? When the examiner asks you to use it. Uh, Tabu says, what about taking a mock? Well, it's a brilliant idea. It's a brilliant idea, but the problem is checking the mock. It's not about taking the mock, but I will definitely think about it. Sanket says, any tip for time management? Yeah. Uh, the best way to manage your time is to first go through your MCQs and solve the most easiest ones. If you find any MCQ difficult, leave it and move towards section B and solve the most easy ones. And if you find anyone that is difficult, skip, go to section C and solve the most easiest ones. And once done, then come back to section A and solve the ones that you found difficult from section A, then to section B, and then to section C. Faheen is asking how many questions should we practice for section C? Well, mm, the best answer to this question will be solve till you get confident. Few people may feel confident after solving 3 or 4 questions in a particular topic for a particular topic, and few people may take more questions. So it totally depends on student. Aksa says, sir, is it necessary to solve the full exam kit? Again, it's a very subjective thing. If I will be if I was when I was a student, I did not need to solve the whole revision kit. If you have a very systematic approach of studying, you don't need more questions to practice. Smart study is better than hard study. So don't work hard, work smart, have a systematic approach. Well, Tabu, very important. It's very important to read examiner's report. Uh, well, you know, I've been teaching for 13 years. I've teaching financial management subject for last 13 years. And I've been teaching uh, this P2P session for last few years now. My experience, if you want me to sum up in one line why students fail the exam, I would say small mistakes. Look for those small mistakes. Usually this paper is flunked because of the very small but conceptual mistakes, highly conceptual mistakes. Yeah, Asad, majority of the students who fail at 49, you know, the reason why they fail, that's my assessment. The reason why they fail at 49 is because of those tiny mistakes that are conceptual, that do make a big difference, but they're very small. Let me give you an example. Let me give you an example. If if you are given a question on investment appraisal and the examiner says that the company will be getting a bank loan to finance a project, and you have to calculate net present value. You have to calculate a net present value of the project, and you have to evaluate based on the net present value of whether the company should accept this project or not. Remember that the bank is going to borrow and is going to take a loan from the company to finance this project, and the bank loan's interest rate is 8%. So my question to all of you is, what should we do? Should we include interest expense in our cash flows or not? Should we include interest expense if we are specifically obtaining this loan for the project? Say, for example, the bank loan is $1 million and the interest is 8%. Should I take this interest as my cash flow if I'm specifically taking this loan for the project? Should I? Everyone should come up with the answer. If I'm taking this bank loan specifically for this project, should I be taking this interest amount into consideration while calculating net present value? You should all clap for Asadullah, because the cost of debt is already part of the cost of capital, and even if we are specifically obtaining a loan from a bank to finance a project, we should not include interest as our cash flow. Remember, that's what I was pointing towards. You people, I just distracted you people by saying again and again that the bank loan has been specifically taken for the project. Most of the students will get trapped because of this information. Number one. My next question to you is, should I use 8% as my discount rate, or should I use cost of capital for this project, knowing that we are taking a bank loan for this project that has a rate of interest of 8%? Should it be 8% for discounting sake, or should it be 12%? So it should be 12%. It should always be WACC. It should not be the borrowing rate, even if we are financing the project through the bank loan, because we are not going to pay interest, only interest to our investors. Whatever we earn from this project will also be paid to our shareholders. They are the ultimate owners of the business. Therefore, we should take WACC into account. So these are the small mistakes that students will usually make, and they will have no idea that they have made this mistake. But do you really think anyone who's making this mistake of including the interest expense in the in the NPV calculation and then discounting it using the 12% rate in which the 8% cost of debt is already included. So it's a very small mistake, but very basic mistake. Do not expect the examiner to be allowing you to proceed to advanced financial management with such a basic blunder in your financial management paper. So this paper has its own dynamics. Look for the small mistakes. Don't make those small mistakes. Any other question before I end the session, because I am done with it? Krishna is asking for the shortcut of money market hedge. So I think I should fulfill my promise and I should show you. So for that shortcut, I want your concentration. So let me do it for you. Let me do it for you. And no more questions now. Just wait for me to tell you the shortcut of money market hedging. That will be good for all of you. Okay, but I need your help. I need your help. We need to calculate a forward rate for. We need to calculate a rate for us, exchange rate for us, using interest rate parity theory, right? Interest rate parity theory. Now, first of all, what was this situation? This was a receipt situation, right? And what were we doing? What was our first step? Everyone, in this money market hedge, what was our first step? What were we doing? We were borrowing US dollars, right? We were borrowing in US dollars, right? So we need borrowing rate of US dollars, right? Okay, then we were investing in pound sterling, so we need deposit rate of sterling. So remember these. So let me write these. What was the borrowing rate? Borrowing rate of US dollar 5.4%. And we should make it a quarterly rate. And what was the deposit rate of sterling? 4.6, the same rate that we used in the money market hedge. $1.5. So okay, you know that in a in a interest rate parity theory, we pick up a spot rate. We pick up a spot rate. So what was the spot rate in this case? The applicable spot rate in case of receipt. There were two, na? So we have to use the one that we use for money market. It was 1.7822, right? Okay. And as I told you, in the numerator, we should always take the rate in which the currency exchange rate is quoted. The exchange rate is quoted in dollars. So in the numerator, we should pick up the interest rate of dollars. But which one? Borrowing or deposit? That will be told by this one. We should pick the US dollar borrowing rate in the numerator. So I just picked it. And I should add 1. So that's the numerator one. Why I picked the dollar rate? Because the exchange rate was quoted in the dollars. So I picked it here. Now divide it by 1 plus R, the other rate. The other rate is 1.15. So that's the rate which we call effective rate. Now, like we calculate the sterling's in case of forward rate, we should be calculating it in the same way, but we will be using this rate now. What was the amount that we will be receiving in dollars? What was the amount that we will be receiving in dollars? 300,000. Okay. And since the rate is in dollars and we are converting it into sterling, so we should divide 167,999 pound sterlings, and look at this magic. In the money market, we got the same amount, $167,999, 1679, 167,999. Hamza, yes, shortcuts are usually very tricky, but they save your time. No, I just simply use the interest rate parity theory formula, but all I have to do is we need to know which rate to be picked. That's what I did. So that's it for today. Krishna, you can watch this lecture again, and in case there is problem, we will be in touch on the WhatsApp group. So thank you so much, everyone. I will be in touch with you on the WhatsApp group. And best of luck for your exams. I hope that all of you pass your exams with good numbers. But I always tell few things to my students. I always advise my students, do not only study for your exams. Think beyond exams. Always think beyond exams. Financial management paper is a wonderful paper, and take this paper or studying this paper as an opportunity for something that will help you even after exams. Learn this paper or study this paper to upgrade your skills, not only your marks. With this, I will be ending the session. But before I end the session, as I have always been asking for feedback, so from 1 to 10, how will you rate these 5 days? Thank you for the high rating. Thank you so much for the prayers. Yes, Sanket, this method can be used for in the exams as well. I'm so happy to know that you people have benefited from these 5 days, and I hope you people will remember me in your prayers. Best of luck. Have a good day. You're most welcome, Sharia. Most welcome. No, Sharia, it's Tabani School of Accountancy. I have so many Indian students. I think you're from India, Sanket, is isn't it? Great. So may God bless you all. Bye.